All right, we are back. We want to complete this exercise. Like I said, I'm going to do another part, which is part 2 of this question. Now, what we must tackle now is the issue of depreciation and wear and tear. Now, you've got an asset here which was bought at 820, bought on this date. The depreciation is 10 years, straight line. Already here, when I did part 1, I've already told you that this one is 20%, right? But now the key thing is that you must remember that it's not apportioned. So if it's not apportioned, that means you put the wear and tear for the whole year every time. The asset touches the year with 1 day, you put for the whole year, right? Now, in relation to this now, I want us to check this calculation here, right? So if you check here, you say, here's the 820. If you take 10% of that 820, that will give you 82, right? Or 10 years. But now remember, 82,000 is for the whole year. The asset has been depreciated only for 6 months in that period after being bought to year end. Remember, your year end is 20. Sorry, it's in February, your year end in this case. Now, so your carrying amount here, you see they're giving us the date here, but the asset was bought here, so it's 6 months from that date to this one here. Now, if you take 820, you divide it by 10 years, it gives you 82, but for 6 months it's 41, which is this one here. So 820 minus 41 will give us this one. Okay. Then come next year, your depreciation is 82 because it's for the whole year now. 820 divided by 10 will give you 82, which is for the whole year. That minus the depreciation will give you this one here. Okay. Then we go to wear and tear. It's 820. But now, wear and tear is 20%. It doesn't matter if it's 6 months. You put like for the whole year, which is 164. 20% of that 820 is that 164. So 820 minus 164 it gives you this one, right? Then you proceed. Come next year, the same thing. 164 is your wear and tear. Then it gives you a tax value of this much, right? Then after during that year, at the end of 2019, which is this one here, end of 2019, there was a sale, which is here, represented here. Here it is, what I'm talking about, this sale here. Right, this sale occurred, and when you look at the calculations in relation to that one, it's talking about this. When you sold the asset, the carrying value and the tax value were these ones here. Right, so that is the first asset that we sold. So you'll see it's deducted here in this line here. This is basically the same that I'm talking about, which comes from the top part here. Right, so you've sold the asset. You'll see that this goes the opposite of the carrying value, the one that you see at the top here, because now the asset has been sold, and you'll see its minuses. That will take us to this one, right? Now, while we are there, okay, now let's remember this now. You've got 820 here, and you sold an asset with a cost price of 500. It's written here. Right. So if I take this 820 here and I minus this, right, 820 minus 500, it gives me 320. It gives me 320, right? The difference between the two, this 820 and the 500. Then I divide it by the 10 years, which is the useful life, right? Or some we can use 10% because 10 years and 10% is the same thing. So that will give you this 32 here, which is the depreciation now of the remaining assets, because remember, from 820 you've sold something that is 500,000. From 820 you sold something that is 500,000. So the depreciation of the remaining assets, it will give you that 32, right? Then 270 minus 32, that will give us the 240. Then you sold another asset, which is this 150. This 150 comes from here, this one, the carrying value. Okay, right. Then you go for this side here under tax value. Now you've got the carrying value here. Now the same thing, 820 minus 500 gives us 320, the remaining assets. But now if you times that by 20%, which is the rate at which you must allow a rent here, it gives you 64. 64 minus that tax value amount, it takes you to 128. Then the asset was sold, which it comes from here, the tax value when the asset was sold. All right, then you've got a balance of 48. All right, now then let me then explain to you all these differences here and the movements. So if you've got this amount and this one, you compare the two. Now let me just try and make sure that you see what I'm then trying to do here. If this one is lesser than this one, it means this 123 here is taxable. I'm going to put a T, but you know taxable means a liability. So in the balance sheet you must have a credit, which is a liability of 36, right? Now your movement is that one, which is T, right? Okay. Then if you come here after the sale, same thing, this 192 is lesser than 272, the 80 is taxable. That will give you a liability again, right? So now let me then use the columns that will give us will show us these movements, right? Let's take let's start with 2019, right? Let's check items under 2019 that are a PPE. It's this 82, this one. So it's 82 minus the 164, which is warranty, minus 164. And then you go and minus this 75 here, minus 75. Then you plus the 200, this one, plus 200. That gives us 43, which is positive. If it's positive, that 43, it means deductible. Deductible equals to asset, right? Debit, the balance sheet, credit, the income statement, right? Right, times that by 30%, multiply that amount by 30%, it gives us 12,900. 12,900. Now let's try and reconcile here to see if we do get this 12,900. Okay, now let's go. You've got 24, which is credit. You've got 37, which is debit. There's two. Now let's check if we get the 12,900. 24, which is a credit, plus the 37.5, which is a debit. That gives me the 12,900. And the 12,900 you can see is a debit. Like I've went that side and checked, and I've checked that it is it gives us that amount when I highlighted this one, this one, this one, and this one. and then I multiply it by 30%, that total, because it gives me a deductible one. When I multiply by 30%, it gave me 12,900. Then I went here and I said, okay, the movement for that period is this one and this one, and I get my 12,900. You can even see it from this side here, these two. All right, that will give you the 37,900 as you see it in the balance sheet as a debit. Right, now let's then again check the same thing that we were doing, but now let's check this here. It's 32 minus 64, and let's see, plus 100,000 minus 30,000. That gives me a positive 38,000. So if it's positive, the amount that I get, it means it's deductible again. Deductible means asset, debit, balance sheet, credit, income statement. If I multiply that by 28% now, because the rate now in this year is this one, which is 28, it gives me 10,640. Now let's go and verify. All right, let's check for that here. 10,640. Right, you've got 19,600 minus 8, 19,600 minus 8,960, 10,640. Okay, see the movement there. I'm taking this one and this one only, and then it gives me the 10,640, which I got from the other side. Now this is the rate change. Okay, so as you go on doing this calculation, remember these ones will give you movement, these ones, what is the movement? Right, it's your movement. Right, now let me show you, let me use 1 year. I'm going to use this year, or maybe let me use 2 this year here. Right, okay, obviously that will come from these two figures here, will come from these two figures here, these two. All right, 32 and 64, they should represent that movement there, that movement here, this line item here, and then this line item here, this one here, is represented here, which is the 82 and 164. Now some of you sometimes might struggle to understand this thing. 82 minus 164. If I say 82 minus 164, it gives me 82, which is a minus. If it is a minus, it is now taxable. Taxable equals to liability. Liability, credit the balance sheet, debit the income statement. Right. So if I'm debiting the balance sheet and then I'm creating the income statement, now let's check if that will give me that. There it is. You see what I'm saying? You see, the 24 is sitting as a credit because we are crediting the balance sheet and we are debiting the income statement, which is the movement part, and it's made out of that. So that is the movement that I'm showing you now. Right, so every time when you have to calculate you want to calculate the rate change, you must always find out what is the balance at the beginning of that year. So you see the balance of Vertex is 24,000. Now the change there is from 30 to 28. So the difference between 30 and 28 is 2. So you say 2 divide by 30, meaning the base, times 24,000. It gives you 1,600. Right. Now, other people, what they do, they take this 80 here, and then they say 80,000 times 28% times 28%. It gives you 22,400. And then you compare to this one. So if I want to move from 24,000 to 22,400, I'm going down by how much? Let me take my 22,400 and then I say minus 24,000. It gives me 1.6. You see, that's the movement. I'm going down. And you'll see the 1.6 is a debit. This opening was a credit. If I take the 2, they give me that amount that I have now, which is 24 minus 1.6. It gives me that 22, which is what you get if you take this and times by 28%. Right. So that is your rate change. You are restating the opening balance to 28% in this case, because this 24 is sitting as 30. So what will be the balance if it was supposed to be at 28%? Obviously, it is 22,400, and we've managed to get it by also putting this amount there. Right. So we've got now the calculation. Now what we need to do is to now vouch these things. Like I've showed you, the 82 and the 32, they're in different years, and then we've got the 164 here and the 64 here. Now they come from this calculation. All those figures there, they come from this calculation. Here is the 82, and here is the 164. Right. And then here's 32, here is 64, which is your wear and tear and your depreciation. Right. Now, what you need then to understand is that everything that is under temporary differences, meaning under this heading, it represents deferred tax. So every time you want to calculate a rate change, you'll see here, we've calculated a rate change, right, which is this one. But this rate change only represents one thing, PPE. And if you check here, let's then now try and define these things. I'm going to highlight what is PPE. This is PPE. And this one also is PPE. All these ones are PPE. They are PPE. Okay. Do you see there are a lot of things that remain? Right. Now, let's then highlight other things like this one and say, let's put this color on this one. And then this one, we put another color, which is this one, the red one. And then on this provision, we put another color, and let's put this one. Right, on research, we put another color. If I put a blue, I can't see. Okay, let's put this one. Right. And then we've got this assessed loss. And let's put another color on that one. Yeah, this one. So if you've already calculated only one thing, which is this one here, and you've got the rate change that relates to it, which is this one here, you only calculated PPE. You only calculated PPE, which is depreciation, wear and tear, non-capital profit, recoupment, loss on sale, and scrapping. But under temporary differences, I do not basically, that's not the only thing that is there, meaning the PPE. You've got income received in advance, you've got expense prepaid, you've got provisions. So technically speaking, in this question, your wear and tear, sorry, not your wear and tear, deferred tax is made out of how many categories? 1, 2, 3, 4, 5, 6 with assessed loss. There are 6. So all of them, that is the reason why when you go here, you will see that income received in advance, for an example, there's a rate change here. You see, prepaid expense, there's a rate change here. And then provision, there's a rate change here. And then research, there's a rate change here. And all these rate changes are then, as a one for assessed loss, all of them are added here to get the total one, which is 98, right? But this one is a bit of a long route. We will engage on the balance sheet approach, which is more or less of a shorter one. All right. Now, let me give you an example in terms of these calculations, how you can deal with them. Okay. Let me take credit losses, meaning the provision, because most of you are familiar with it and you won't struggle. Now, I'm going to start with this figure here. Right, and then I'll move on, and then once I've showed you that, then obviously the application in terms of what I'm doing, you can do it in the other ones. Right, let's go here so I can demonstrate to you how do you at least analyze these figures there. Okay, now I was dealing with credit losses. Now I'm here, I'm dealing with this. Right. Now, what I want us to do is to analyze the credit losses in 2019. Right, analyze the credit losses in 2019. Now, if you look at 2019, you will see that what is my opening in 2019? It's this figure here, 8,000. So this 8,000 comes from 2018 as closing, isn't it? Because if something is opening here, it was closing last year. Right, so it comes from 2018, but be careful of the sign because it means it was not in a bracket in 2018. It became in a bracket in 2019. So if something is opening, the sign is different when it is closing. Okay, so now what then has happened here is that when you look at it, you will then realize that the 8,000 was sitting as a positive figure in 2018, right? So I'm just writing down my 8,000 down. Then what is my opening here? My opening is this one here, 1.6 under allowances. So it was 1.6, but it was in bracket because this year it's not in bracket. You see, as an opening is not in bracket. So last year it was in bracket. So 8,000 minus 1.6. So 8,000 minus 1.6, it gives me a total of a positive amount of 6,004. Right. This, if I move it to last year, it changes the sign, it becomes positive. This, when I move it to last year, it changes the sign, there's a minus. So if I say 8 minus 1.6, it gives me 6.4. Right, which is this 6.4 here. Here is the 6.4 I'm talking about. It's made up of 8,000 minus 1.6. And the 8,000 minus 1.6, it comes from here. Right. 8, this one. But if you push it to last year, this year, or I mean 2018, if you push it to 2018, this 8,000, remember, if it is opening here, it was closing last year. So you change the sign, it becomes positive 8,000. This one is opening, it was closing last year, it becomes a minus. Now, if you take the 2, 8 positive 8 minus 1.6, it gives a positive 6.4. And that positive 6.4 is deductible because what I'm simply saying, I'm saying in the prior year, meaning in 2018, this 8 was closing. It was somewhere here. It was in line with this one here. Here in 28, it was somewhere in line with that one. But it was 8 here last year. Right. Then the prior 1.6, this one becomes a minus, and that as a closing figure. Then the difference between 8,000 minus 1.6, it's 6,000. It's deductible. Deductible equals to asset. Right. Now, you'll see here, you've got a, if you multiply that 6.4, this one, by the tax rate of 30, it should give you this. You see this one? And it's a debit, like I said. Okay. Then you go to this coming year in 2019. So in 2019, you are here. There we go. Now look at this part here. This 6,000 minus 8,000 minus 1.2 plus 1.6. That gives you a minus 1,600. Right, that gives you a minus 1,600, which is here. There it is. If you multiply, and if it's a minus, it's taxable. Taxable means equals to liability. If you multiply it by 30%, it gives you 480. Here's the 480. Right. Then after that, you do what we call a rate change. Right. Now our balance is debit, this one, which is a debit, credit. Our total is 144 debit. Okay. Then you do a rate change the same way. You say, I'm moving from 30 to 28. The difference is 2. Divide by 30 times 1,440. You see, it gives you 96. Okay, which is this one. That gives you a rate change. Now, right. Then you take this plus the 96. It gives you this figure here. Then you go to this here, which is this one here. There we go. Here. Now take 9,000. 9,000 minus 6,000 minus 1.8 plus 1,002. It's 2.4. But you see the 2.4 comes out as a positive amount, meaning it is deductible. Deductible equals to asset. Multiply that by 28%, the tax rate. It gives us 672. There we go. There. Here is 2.4 multiplied by the tax rate. It gives us 672. And like I've said, it is taxable. Debit this side, credit that side. So then in total, now you've got this 1344 debit plus 672 debit. It gives us a total of 2016. Now you'll see the 96 represent provision, right, which is here. So let's count these categories. 1, 2, 3, 4, 5, 6. Like I said when I was highlighting that side, that there are 6 categories under temporary differences. For each category, you must calculate its own rate change. Okay. Now you can proceed in terms of these calculations, how I've been doing them, like I did on under provision. You'll then see that they give you the answers. Now what I want to entertain is this calculation here. Okay, let's then check this calculation. I will start with this part here. All right, that part is the balance at this date. Right, if you come here in 2019, if you come to 2019 here, it's this line here. Right, obviously 2020 will be this one. Right, so 2020, which is this line here, it comes from that part. Okay, now then it tells you that like for an example here, the tax value is lesser than that one. The 42, which is this one, is taxable, and that will give you a liability like you see there. So exactly the same thing here, because 192 is lesser than 72, this is taxable. Okay, right. Now if you then look at this thing this way, now let's start now and then let's deal with item by item. So delivery vehicle is clear, straightforward. Let's look at the research, this one here. Now research in 2019 was expense. You've expensed, let's get it here, right? Research, you'll see here that this is the reversal, né? But here under expenses, you've put an expense of 20,000, which was research. And then the receiver reversed it here and then put an allowance of 5. Now let's agree that if I've got 20, but I'm only allowed by the receiver 5, the receiver still need to allow me another 15. From that 20, he's only allowed me 5, so there's another 15 that he must still allow me in that 2019 period. So you'll see here is then the 15 that he must still allow you. From 20, you are allowed 5, then the 15 remains. And this, now, if you look at the issue here, you'll realize that this research cost will behave in the same manner like the delivery vehicle, right? But now the difference is that the research cost is doing the opposite of what the delivery vehicle is doing. So then the 15 here becomes deductible, right? If I analyze, this is the small figure is this side, it's taxable. But if the small figure is this side and they behave the same, it becomes deductible now. It's doing the opposite of that. Okay. Then we come to the assessed loss. Again, the assessed loss is behaving the same way like delivery vehicle, research cost, and the assessed loss itself. So you'll see the small figures are on the left, which is accounting. The big figures are on the right, which is tax, meaning this becomes deductible. But in any way, the principle says if an assessed loss, in the year when an assessed loss arises, it becomes deductible. When you offset it, it becomes taxable. Right. So it arose in 2019. So obviously, when it started, then it should give us that. Okay. Then we get to prepaid expenses. Right. Prepaid expenses, they are an asset. Right. So if you check here, what is the balance of prepaid expenses in 2019? Here it is, 70,000. All right. So in the balance sheet, according to accounting, I must show prepaid expenses of 70,000. But remember, the receiver allows you the whole amount. They tax you the whole amount, they allow you the whole amount. They don't have prepayments and income received in advance. So that is why there's a 0 here, because the receiver allowed you that amount long time ago. And so that is the situation. So if you read them again, the same way like you are reading these ones. Okay. If you are reading this whole thing here, the same way, all these figures we are reading them the same way. Let's take prepaid expenses and look at delivery vehicles. The small figures are on this column here, and the bigger ones are on this column here. So it tells you that obviously that must behave the same, T, just like what is happening under delivery vehicle. Then you multiply by the tax rate, it gives you 21, which is liability. Okay. Income received in advance is a liability, right? So income received in advance, the balance that here is 12.5. And then you see, here is the balance here. But also income received in advance and prepaid expenses. They are taxed at the same time, and they're allowed at the same time, meaning they do not carry over to other years. Right, then the receiver will say it's 0. If then now I look at them, if I look at these two, the small figures on my right, the big figures are on my left. But you must remember they're not the same in terms of their nature. Prepaid expenses is an asset. Income received in advance is a liability. If they look similar, that means this one must behave in a different way. It becomes deductible. Right. Okay. Then I move on. Then I get to provisions. A provision is what we call a contra asset account, meaning if an asset is a debit, the provision is a credit, right? So automatically, if it's a credit, it behaves like a liability. So these two, I'm expecting them to behave the same. These two, they must behave the same. Now, when I look at them, both of them, the big figures are on my left, the small ones are on my right. So they look the same. So that means even this one must be 80. Right, because small figures are on this column here, the bigger ones are on this column, so they must create an asset. Now, if I then add all these items here, meaning if I add this column here, this one here, it gives me a total of 49. If I add this column here, it gives me 1470. Now, I want to do the rate change of 98. Right, I've got two choices. I can take this 1470 times 2 divided by 30. It gives me the 98, this one. So obviously I'm going down. So you'll see the movement of 98 is a credit against the balance that I had of a debit. Okay. Now, or what I can do, I can take this figure here and say, multiply that figure by 28%. Right. It tells me that I'm supposed to be here. If I do that, but I'm here. So how do I move from here to here? The movement in between, it's minus 1470. It's 1470 minus 1372. It's that 98 in the middle, see, which is my rate change, right? So you can apply the same logic to all these next coming figures, the 25, the same logic that I've been basically showing you in terms of the balances. Okay. Now, you've got that rate change of 98. All right, and I've showed you these figures here, how you can calculate them, right? So just to solidify this thing, one thing that maybe some people might be lost somewhere is this one here, and I just want to explain this one only. So this asset, the research cost here in this year here. Now, when you look at it, you will realize that it is putting 32 here. Let's find out. Right, why is it 32? Let's start with this 20. 20, there's a 5 that is allowed here. Then there's a 5 that will be allowed next year. So it gives us a 10, a balance of 10,000. From this 20, there's it's 5, 5, then the balance is 10, right? Then we come to this 30. 30 minus 7.5. There's a balance of 22 this side here. 30 minus 7.5. Plus the 10 that remains from this 20 now, this 20 here. It's 20, 5, 5. Gives us a 10, plus 10,000. So it gives us 32. 22. Remember, here, for this year, if you divide this by 4, it gives you 7.5. If you minus 7.5 from this, gives you 22. All right, if you minus 7.5 from this 30, it gives you 22. Now, this 20, if you minus this 5 here, and the 5 again that is here in that 7.5, you get 10. So if you add the 2, they give you this, which is 32. Right. Now, for this question, that's basically that. So my expectations are that by now then you should be able to deal with this whole question as stated, because if you look at the required, we are able now to answer the whole question. So we usually keep the structure the same, especially for exams and tests. Thank you very much.